You're in your 20s, with your entire future ahead of you. Retirement might not be at the forefront of your mind right now, but starting to plan now can make a significant impact. Today, we're delving into two essential types of tax-sheltered accounts available in the UK that can help you build wealth for your future: ISAs and pensions. We'll use Monte Carlo simulations in Portfolio Visualizer and Tmeline Planner to compare outcomes between these investment accounts. If you find topics like this helpful, take a moment to subscribe for future content. Your support is very much appreciated. Before we start, let's have a quick overview of ISAs and pensions. ISAs, or individual savings accounts, are a way to save or invest money without paying tax on the interest or returns. You can put up to £20,000 a year into ISAs, and you can take your money out whenever you want. The catch? You're putting in money that's already been taxed. Pensions, on the other hand, are specifically designed for retirement savings. You get tax relief on the money you put in, which is like a bonus from the government. Plus, if you're in a workplace pension, your employer will usually chip in too. You can currently contribute up to £60,000 annually to your pension, subject to potential reductions based on your income. The downside? You can't touch the money until you're at least 55, rising soon to 57 in April 2028. So, what are the other differences? Pension contributions benefit from tax relief, effectively boosting your savings alongside potential employer contributions. Over time, compound growth of the tax relief contributions can significantly enhance your retirement pot compared to ISAs. It's hard to say no to that. Plus, the £60,000 annual pension allowance is higher than the £20,000 annual allowance for ISAs, and your pension avoids inheritance tax. As a bonus, you can carry forward any unused pension allowance from the 3 previous tax years. This feature is immensely powerful for those with an unexpected windfall. While ISAs do not offer upfront tax relief, all withdrawals are tax-free and accessible anytime. This flexibility is ideal for those who might need access to their savings earlier than the normal minimum pension age. This flexibility makes ISAs ideal for those planning to retire earlier than 55. Feel free to pause the video at this point to review the table in more detail. We're going to compare ISAs and pensions to see which one is best for maximizing your long-term savings in retirement. We'll break it down into 2 phases: the accumulation phase, when you're working and saving, and the decumulation phase, when you're retired and drawing from your savings. For our scenario, let's imagine a 25-year-old who saves a fixed £250 a month for 40 years, retires at 65, and plans for a 30-year retirement. But will this be sufficient to fund the full 30-year retirement? We'll use the Retirement Living Standards cost for a moderate lifestyle, which is £31,300 a year as of 2024. To really stress test this, we're going to assume no other income in retirement, no state pension, no part-time work, nothing. Just living off those savings. Today, we're going to use a tool called Portfolio Visualizer to compare the outcomes of ISAs and pensions in different scenarios. Portfolio Visualizer allows us to simulate investment returns using Monte Carlo simulations, giving us a possible view of how our investments might perform over time. We'll be focusing on a custom, globally diversified, 60/40 portfolio that we have set up in Portfolio Visualizer for this exercise. This allocation helps us evaluate the potential growth of both ISAs and pensions as we save for retirement and draw down our savings later in life. It's important to note that this allocation might not be suitable for all investors. Younger investors might benefit from a more aggressive allocation, such as 80/20 or even 90/10, while those closer to retirement might prefer a more conservative allocation, with more bonds. Let's start with the accumulation phase. Contributions to a SIPP receive automatic tax relief, adding 25% from HMRC to your contributions. When you pay in £250 monthly, your total annual pension contribution is £3,750, not just £3,000, in UK terms, thanks to the tax relief. That is an additional £750 from HMRC. After 40 years, our Monte Carlo simulations show that the median outcome, so a 50% chance of this happening, is a final balance of about £800,000. If you wanted slightly more confidence, the 30th percentile outcome is £600,000. Either way, that's pretty impressive for an effective £250 a month out of your pocket. For ISA, investing that same £250 a month gives us a median outcome of about £630,000. That's a £170,000 difference just from that tax relief on the pension contributions. That's the power of compounding on the HMRC tax relief. Now let's look at the decumulation phase, when you're retired and withdrawing money. This gets a bit more complex because of taxes. Remember, you got tax relief on your pension contributions, but you'll pay tax on the withdrawals. The question is whether this negates the benefit of the tax relief. Even though you'll pay taxes on some of your pension withdrawals, the portfolio visualizer simulations suggest that the tax relief you received earlier in the accumulation phase, combined with the power of compounding, still puts pensions ahead in the decumulation phase. The simulations show a median ending balance of a staggering £1.9 million. This is consistent with what Michael Kitzers found in his analysis of the 4% rule. He found that, in over two-thirds of cases, retirees ended up with more than double their starting principal by the end of the 30-year horizon. A brief note on Portfolio Visualizer. It isn't designed for the UK tax system, so these figures are estimates. Additionally, I have changed the tax treatment configuration from pre-tax to post-tax, and set the federal income tax at 20%, to reflect the UK basic tax rate. Let me know in the comments if it is incorrect or if there is a better way to configure this. The ISA, starting with £630,000, ends up with a median balance of £900,000. It's important to remember that Portfolio Visualizer isn't designed specifically for the UK tax system, and these figures are estimates. To model tax-free withdrawals for ISAs, I adjusted the tax treatment back to pre-tax. However, due to Portfolio Visualizer's limitations, the accuracy of UK tax outcomes are approximate, at best. Additionally, these are just simulations, but the pattern is clear. Pensions have a significant advantage when it comes to maximizing your retirement savings. Comparing contribution and withdrawal outcomes side by side, despite taxes on pension withdrawals, the final portfolio balance is higher than using an ISA. Another interesting finding: in the contribution scenario, the portfolio balance for the higher confidence pension 30th percentile is nearly as high as the lower confidence ISA 50th percentile. This clearly shows that pensions are preferable if your goal is to maximize your portfolio balances during both the accumulation and decumulation phases. Let's validate these numbers in Tmeline Planner, which considers UK taxes. It's crucial to note that slight variations in assumptions can lead to significantly different outcomes. To align both models, I adjusted the Tmeline Planner configuration. I added a custom 60-40 portfolio, 60% HSBC FTSE All World Index Fund, and 40% Vanguard Global Bond Index Fund. I also adjusted the historical inflation and standard deviation to match the settings in Portfolio Visualizer, 2.54% average and 1.20% standard deviation. The portfolio end balances were very close, except for the ISA 30th percentile, which Tmeline Planner estimates could potentially have a higher balance than what Portfolio Visualizer suggested. But, big picture, the two sets of decumulation outcomes were very consistent and produced very similar ending balances. To summarize our findings across both phases: pensions beat ISAs in both accumulation and decumulation phases. Interestingly, pensions still won during decumulation despite taxes on pension withdrawals. In short, prioritize saving into your pension over an ISA, if your aim is to maximize your retirement savings and portfolio longevity. However, it's prudent to have some investments in a stocks and shares ISA, even if pensions should be your primary focus. The flexibility of ISAs allows you to access funds if needed before reaching the minimum pension age, providing a safety net for unexpected expenses or opportunities. Here are 5 further considerations. First, if you have a general investment account, spend that down first in retirement. It's the least tax advantaged, so it makes sense to use it up and let your tax-advantaged accounts keep growing. The analysis published by Vanguard Research in 2019 supports this approach. Second, if you're planning to retire at the normal pension age or later, focus on your pension during your working years. If your goal is to retire earlier, it's essential to build a larger ISA portfolio to support you, until you can access your pension funds. Third, if leaving an inheritance is a priority to you, you should spend pensions last, which is outside your estate for inheritance tax purposes. ISAs, on the other hand, form part of your estate for inheritance tax purposes. However, if you are not planning to leave an inheritance, then spending your pension first has several advantages. This strategy reduces tax liabilities early in retirement, especially considering lower inflation-adjusted income needs during the early stage of retirement. It also allows your ISA investments to benefit from compounding growth. Fourth, keep in mind the money purchase annual allowance or MPAA, particularly if you're contemplating a phased retirement or part-time employment. Once you take a taxable withdrawal from your pension pot, you trigger the MPAA. This reduces your annual pension allowance from £60,000 to £10,000, significantly limiting your ability to continue building your pension savings. So, think carefully before making taxable withdrawals from your pension, as this can limit future contributions. Fifth, compounding transformed a modest £250 monthly contribution into £800,000, enough to sustain a 30-year retirement and leave behind a £1.9 million estate. That's the power of compounding. However, for compounding to reach its full potential, it requires time. That's why it's essential to begin investing as early as possible and maintain disciplined financial habits. Before we wrap up, let's emphasize one more crucial point. While pensions often offer superior financial outcomes, it's prudent to maintain investments in a stocks and shares ISA alongside your pension. This is important for one reason: access flexibility. ISAs provide a financial safety net you can tap into any time without penalties. This could be crucial for unexpected expenses, opportunities, or if you decide to retire early. ISAs can serve as a tax-efficient means to bridge the gap until you have access to your pension. If you're still here, thank you for your time, and I hope you found this helpful. Don't forget to like, share, and subscribe for more content. Thanks again for watching, and I'll see you in the next one.